The era of ultra-loose monetary policy in Japan is reaching a critical turning point. Bank of Japan Governor Kazuo Ueda has signaled a shift into inflation-fighting mode, preparing the markets for more consistent interest rate hikes. By the end of this video, you'll discover how this pivot could trigger a massive unwind of yen carry trades and what the 160 yen level means for global liquidity. For years, Japan has been the global outlier, maintaining negative interest rates and aggressive easing. This policy provided the world with cheap yen, fueling carry trades into higher-yielding assets everywhere. However, persistent inflation pressures are finally forcing the BOJ's hand. This shift isn't merely a domestic change, it's a structural transformation that will reshape the global flow of capital as the BOJ moves toward normalization for the first time in decades. According to reports from Reuters, Governor Ueda is clearing the path for steadier rate hikes. He explicitly stated that the central bank should discuss raising interest rates if inflation pressures continue to increase. This marks a departure from his previous, more cautious stance. The market is now closely watching the June policy decision, as Ueda has shown he is open to further rises. This signal is crucial because it suggests the BOJ is no longer just testing the waters but is committed to an active tightening cycle. On social media, reactions have been intense. Market participants are debating whether this pivot is timely or dangerous. Prominent FX traders like Kathy Lean have noted that despite Ueda's mixed comments, yen weakness remains a significant factor as the pair tests psychological limits. Investors are closely monitoring every word from the BOJ, as the potential for a June rate hike significantly raises the odds of government intervention to support the currency near the 160 level. Not everyone agrees with the BOJ's new direction. Renowned economist Steve Hanke has issued a blunt warning, calling a rate hike a mistake. Hanke points out that Japan's money supply is currently growing at only 2.3% per year, which he argues is well below his golden growth rate of 6% needed to sustainably hit a 2% inflation target. This critique suggests the BOJ might be tightening prematurely, potentially choking off growth while the underlying monetary foundation remains weak. The shift in BOJ policy is already rippling through the equity markets. Higher rates typically benefit the financial sector but can pressure global risk assets as liquidity tightens. Analysts observe that the potential end of the ultra-loose era is forcing a re-evaluation of Japanese equities. While a stronger yen might hurt exporters, the move toward normalization signals confidence in the domestic economy. Investors are now pivoting their strategies to focus on sectors that can withstand or even benefit from a rising interest rate environment. The US dollar to Japanese yen pair is currently holding near the 160 level, a zone fraught with intervention risk. As bets on BOJ tightening intensify, the risk of a carry trade unwind grows. When the yen strengthens unexpectedly, investors who borrowed in yen to buy global assets are forced to sell, creating downward pressure on everything from US tech stocks to emerging market bonds. This repatriation of capital is the primary mechanism through which Japanese policy shocks hit the rest of the world. For individual investors, this environment demands extreme caution. The primary risks are heightened volatility and sudden policy-driven market moves. Watching the June BOJ decision is essential, as any deviation from expectations could trigger sharp currency swings. Diversification and risk management are key, especially for those exposed to yen-denominated debt or global risk assets sensitive to Japanese liquidity. Avoid chasing rapid moves near intervention levels, as the Ministry of Finance remains ready to act. Our AI analysis suggests three potential paths. In the base scenario, the BOJ implements a steady, measured hike in June, leading to a gradual yen strengthening and minor volatility. The bull scenario for the yen involves a more aggressive inflation-fighting stance that pushes US dollar to Japanese yen back toward 145, potentially causing a sharp correction in global equities. In the bear scenario, the BOJ hesitates despite inflation, causing US dollar to Japanese yen to blow past 160, forcing a massive, chaotic intervention by the Ministry of Finance. To summarize, Governor Ueda is shifting the BOJ toward an active inflation-fighting mode. This pivot puts the 160 yen level in focus and threatens to unwind global carry trades. Whether this move is a necessary step or a policy error, as Steve Hanke suggests, will be clear after the June decision. Stay informed by subscribing to Tokyo Macro for deeper insights. What do you think? Is the BOJ tightening too soon? Let us know in the comments below.